Hello, I'm Ben Jones. You're watching Dukascopy TV. China manufacturing PMI data has once again fallen short of the figure that signals expansion, showing a further slowdown. Joining me on the line to talk about this figure is Benjamin Charlton from Oxford Analytica. So Benjamin, the preliminary data has gone up from last month's final of 48.0 to 48.3, but a contraction is still being signalled. What aspects do you think are contributing to this?
First of all, I'd just like to urge caution regarding this data point. It's based only on about 350 to 400 companies, and while this can tell you something, it seems quite possible that the kind of small fluctuations we've seen in recent months are within the margin of error. If you look at the NBS data from last week, that showed manufacturing still looking really quite robust over the first quarter. So this is really only part of quite a mixed picture. If we assume that the sector is contracting, then if we look at the sub-indices from the PMI today, we see export orders declining again, domestic orders continuing to decline. Domestically, manufacturing is linked to other sectors, so inventories building up could lead to less demand in, say, goods related to property. We've seen the property sector slowing recently, so things like white goods, furniture, and so on. We might see the impact of the government's anti-extravagance or official austerity campaign, so kind of retail purchases by government departments and state enterprises scaling back, and the slowdown in the pace of investment as well as credit tightens.
Now, the weak manufacturing data saw the yuan drop to its lowest levels in 16 months, and confidence in the currency is wavering. Do you think if we continue to see a contraction, then the currency could be significantly weakened?
One might expect maybe more short-term volatility in the currency than there has been up to now. I can't see it being weakened to the extent that there's any risk of serious capital flight. For one thing, China, as we know, has the world's largest currency reserves. The authorities have shown a credible commitment to using them to stabilize the currency as they feel necessary. So the renminbi, one would expect, is only going to weaken to the extent that policymakers are happy with it doing so. For another thing, China's economy overall, as I was saying, the PMI is just one data point and not the most comprehensive. And as we saw in the GDP data last week, the economy overall is still growing really pretty quickly, if not perhaps as quickly as it was before. I think for a dangerous and sustained slide in the renminbi, you'd really have to see GDP growth fall not only significantly below what it is now, but for that slide to happen suddenly rather than gradually, and for there to be evidence that whatever stimulus measures the government adopted, which it certainly would in that instance, hadn't worked.
Now, China have put into place what some are dubbing as mini stimulus packages to try and aid growth, such as railway spending and tax relief. But do you feel more will be required to get the manufacturing sector out of this contraction? Well,
I think the key is employment rather than growth or contraction as such. I think that's been the case for a while, and recently you've started to see key figures in the government coming out and saying as much. The leadership expects manufacturing growth to slow as a necessary part of economic rebalancing. They expect manufacturing to play less of a role in the economy than it has done previously. So they're able to tolerate slower growth or even contraction temporarily as long as employment holds up. The employment subindex in today's PMI did show declining employment, but that's again only one data point. The official unemployment data aren't very credible, so the key thing might actually be the reports from local governments on the ground about how the employment situation looks. Now, the stimulus measures, the mini stimulus measures, the point really there, I think, is to support the construction industry through these infrastructure projects by soaking up workers laid off by the slowing property sector, and perhaps manufacturing to to support consumption in the long term. This is part of their rebalancing program. So through urbanisation, the building of railways and social housing are major parts of the mini stimulus. And yes, to support small manufacturers using these extended tax cuts. Though I think they aren't necessarily worried about some small low-end manufacturers scaling back or even failing. As long as the transition to higher value-added industries continues and the service sector is able to soak up any workers laid off as a result of that slowdown, which so far seems to have been the case.
Thank you very much for joining us today, Benjamin. That's all from me. Thanks for watching, and click back later on in the day as Durham McDermott will be discussing the UK rate votes. But for now, goodbye.